Welcome back to the Longacres Finance channel. Today I want to show you my top 10 holdings across my 3 portfolios. My 3 portfolios are my Roth IRA account with M1 Finance that has a market value around $5,600 right now. I also have a personal taxable account on M1 Finance with a market value of about $7,500 right now. And my largest portfolio is with Charles Schwab, and it has a market value of a little more than $109,000. Combined, the 3 portfolios are worth about $122,000, and they are forecasted to generate about $2,500 in dividend income this year, which gives me a dividend yield just above 2%. The top 10 holdings across all 3 portfolios currently make up about 23% of the total market value, and they generate about 20% of the total annual dividend income. I wouldn't say that my current portfolio structure is concentrated at the moment, because allocating a quarter of the portfolio to 10 stocks is fairly common even for index funds. I practice a rules-based investing approach, and if this strategy will make my portfolio more concentrated in the future, I will be perfectly fine with that. Okay, so let's take a quick look at each of the top 10 holdings right now. The largest holding is Texas Instruments. The stock has a current dividend yield of about 2.5% right now. It has a very safe dividend according to Simply Safe Dividends. Texas Instruments makes up 2.75% of my portfolio and generates $82 of annual dividend income that accounts for 3.2% of my total annual dividend income. My yield on cost is just slightly better than the current dividend yield. I have also added to this position recently as the share price declined sharply earlier this year. My current gain from this position is about 1%, so pretty much flat at the moment, but I intend to hold my shares for a long time. Texas Instruments has an 18-year streak of dividend growth and a 33-year streak of uninterrupted dividend payments. It has also grown its dividend at a very fast rate of above 20% during the past 20 years. The latest dividend increase in September of 2021 was 13%, below the long-term average, but still at a healthy and very fast level. The current dividend yield sits very close to the trailing 5-year average, implying shares are fairly valued today. My second largest position is Charles Schwab, that offers a rather low 0.88% dividend yield right now. It has a very safe dividend with a safety score of 99. The stock makes up 2.4% of my portfolio and generates $26 of annual dividend income. That accounts for just 1% of my annual dividend income. My yield on cost of 1.28% is much nicer than the current dividend yield. My position in the stock is up about 45%, which is a pretty good gain. I am currently not adding more capital to Schwab, but may add more in the future if the stock trends higher on my monthly watch list. Charles Schwab currently doesn't have a dividend growth streak, as they failed to raise their dividend last year. However, the company did announce an 11% hike in January of this year, and I was very pleased to see the dividend increases resume again. Also, Schwab has a 31-year streak of uninterrupted dividend payments. Long-term dividend growth has been very fast, with a rate of 22% during the past 5 years and 15% during the past 20 years. The current dividend yield is below the 5-year trailing dividend yield, implying shares are trading for a premium right now. The third largest position in my portfolio is Amgen, that sports a more attractive dividend yield of about 3.3%. The stock has a safe dividend with a safety score of 74. It makes up 2.4% of my portfolio and generates $95 of annual dividend income. That is 3.7% of my total annual dividend income. My yield on cost is 3.41%, which is a little better than the current dividend yield. The position is up about 3%, so a modest gain from Amgen thus far. I am currently adding more capital to this stock, so this position should get bigger in the future. I'm also pretty close to crossing the $100 mark in annual dividend income, which will be a nice amount to receive. Amgen has a 10-year streak of dividend growth, with a very fast growth rate that has cooled off more recently. The 10-year growth rate is nearly 30%, with the last 5 years averaging about 12%, and the latest dividend increase clocking in at just 10%. It's natural for dividend growth to be elevated, especially with a relatively short period of growth, but it is nice to see Amgen holding on to a double-digit growth rate after a decade of hikes. The current dividend yield looks to be well above the trailing 5-year average, implying that shares are trading at a bargain price right now. My fourth largest holding is Mastercard, with a rather low dividend yield of about 0.5%. The company has a very safe dividend with a safety score of 99. This position makes up 2.3% of my portfolio and generates just $15 of annual dividend income. That accounts for just 0.6% of my total annual dividend income. My yield on cost is right in line with the current dividend yield, and my position has a small loss of about 1%. Mastercard had a pretty rough past few months. I've added to my position on this weakness, but have stopped contributing more recently. They have a 10-year streak of dividend growth with 15 years of uninterrupted dividend payments. Dividend growth has been very fast, with an annual growth rate of 41% per year during the full 10-year history. More recently, this growth has slowed down to 18% per year over the past 5 years, with the latest dividend increase last year being just 11%. The dividend yield appears to be in line with the 5-year trailing dividend yield, implying shares are fairly valued. There have been a few opportunities to purchase Mastercard with a more attractive dividend yield, but it does not deviate much from its long-term trailing average. My fifth largest position is Amphenol, with a dividend yield of about 1% and a dividend safety score of 87. The stock makes up 2.2% of my portfolio and generates $28 of annual dividend income. That accounts for 1.1% of my total dividend income. My yield on cost of 1.11% is a little bit better than the current dividend yield. My position has a modest gain of about 7% right now. Amphenol has a 10-year dividend growth streak and 16 years of uninterrupted dividend payments. Dividend growth has been very fast, with the long-term 10-year average growth rate being 45%. During the past 5 years, this growth rate cooled off to 17% per year. But more recently, the company announced a 38% dividend bump that was a very pleasant surprise. The current dividend yield is higher than the trailing dividend yield, implying shares are trading at a discount right now. I am currently adding to this position as I believe the stock looks attractive and should do well in the long run. My sixth largest position is Lowe's, with a dividend yield of about 1.4% right now. The stock has a very safe dividend with a safety score of 93. It makes up 2.2% of my portfolio and generates $37 in dividend income. That accounts for 1.4% of my total dividend income. My yield on cost of 1.74% is much nicer than the current dividend yield. I also have a gain of about 28% right now. Lowe's has an amazing streak of dividend growth at 59 years. I bet that's longer than many of you have been alive. And to make things better, the company is still generating very fast dividend growth. The long-term 20-year average dividend growth rate is 24%. The past 5 years have an average growth rate of 18%. And more recently, the company bumped its dividend by 33%. I can't wait to find out what dividend increase is in store this year. The current dividend yield is below the 5-year trailing average, implying shares are trading for a premium right now. I have not been adding to my position recently, and probably won't do so unless the dividend yield gets more attractive. My seventh largest position is Morgan Stanley, with a dividend yield of nearly 3% right now. It has a decent dividend safety score of 55 that implies it's borderline safe. The stock makes up 2.2% of my portfolio and generates $78 of dividend income. That accounts for 3.1% of my total dividend income. My yield on cost of 3.19% is better than the current dividend yield. The position has a modest gain of 8% right now. Morgan Stanley has an 8-year streak of dividend growth and a 12-year streak of uninterrupted dividend payments. Of course, I have to note the company did cut its dividend during the financial crisis of 2008. They did resume paying dividends shortly after, but it took nearly a decade for the dividend to get back to its pre-cut levels. Because of this, the long-term 20-year dividend growth rate is just 5% per year. The 5-year dividend growth rate is much more attractive at 27%, and the company also did bump its dividend by 100% last July. The current dividend yield is above the trailing dividend yield, implying shares are attractively priced today. I have been adding to this position, and I will probably continue to do so in the foreseeable future. My eighth largest position is Tractor Supply, with a dividend yield just north of 1.5%. It has a safe dividend with a safety score of 68 right now. The stock makes up 2.2% of my portfolio and generates $41 of annual dividend income. That accounts for 1.6% of my total dividend income. My yield on cost of 2.25% is much nicer than the current dividend yield. My position also has a nice gain of about 43%. Tractor Supply has an 11-year streak of dividend growth, with a very fast long-term growth rate of 25% during the past decade. The 5-year dividend growth rate of 18% is a little lower, but still very strong. In January of this year, the company bumped its dividend by 77%, which was a big and welcome surprise. The current dividend yield is above the trailing dividend yield, partly due to the large dividend increase. I have been adding to my position recently, and will continue to do so in the near future. The ninth largest holding in my portfolio is T. Rowe Price Group. The stock has a dividend yield of 3.25% right now, with a dividend safety score of 94. It makes up 2.2% of my portfolio and generates $86 of annual dividend income. That accounts for 3.4% of my total dividend income. My yield on cost of 2.95% is below the current dividend yield. My position is also down about 9% right now. T. Rowe has a 35-year streak of dividend growth that is almost as long as I've been alive. The long-term dividend growth rate is very fast at 14% per year. The past 5 years have kept up with this long-term pace, averaging 15% per year. Last month, the company bumped its dividend up another 11%. It's fantastic to see such strong dividend increases after 35 consecutive years of dividend growth. The current dividend yield is above the trailing dividend yield, implying the stock is undervalued right now. I have been adding to my position recently, and will continue to do so at this attractive dividend yield. Rounding out my top 10 holdings is United Healthcare, with a dividend yield of about 1.15%. They have a very safe dividend with a safety score of 99 right now. The stock makes up 2.1% of my portfolio and generates $29 of annual dividend income. That accounts for 1.2% of my total dividend income. My yield on cost of 1.59% is much better than the current dividend yield. I am also up about 39% on this position, which is a solid gain. United Healthcare has a 12-year streak of dividend growth and a 29-year streak of uninterrupted dividend payments. The long-term dividend growth rate is very fast at 39% per year. The shorter 5-year dividend growth history is also very fast at 19% per year. The latest dividend hike of 16% came in June of 2021, which means we are pretty close to the next dividend increase announcement. The current dividend yield is well above the trailing average, implying shares are trading for a premium right now. I have not added to this position recently, and probably won't add in the near future. There you have it, these are my top 10 largest holdings right now. If you enjoyed the video, please give it a like and subscribe to the channel. Thank you for watching and see you next time.